Hello and welcome to the BizNews Breakfast Briefing. I'm Lucy Ferreira for biznews.com. In today's show, former UK Cabinet Minister Lord Peter Hain continues to pile the pressure on his government to blacklist controversial consultancy firm Bain Co. Whistleblower Athol Williams and Hain met with a UK Cabinet Minister to state their case and spoke to Michael Apple about it in a joint interview. And then, South Africa continues to wait with bated breath for President Cyril Ramaphosa to announce his grand plan to fix the ailing power utility. Michael Apple caught up with Shadow Minister of Public Enterprises, Caleb Kachalia, for his thoughts on an Eskom 2.0. And lastly, we have the daily news update from our partners, the FT in London. First up, though, it's Alec Hogg on the markets.
Thank you, Lucy. Good morning. It's Friday, the 22nd of July. Well, Tesla led American shares higher last night. The S&P 500 index up 1%, the Nasdaq Composite up 1.5%. You might recall that Tesla released its financial results Wednesday night after the market closed in America. When it reopened last night, they ran like the clappers. Tesla up by 10%. Pulled some of the other favorites of ours along with it. Palantir 3.75% higher, Cloudflare 5% higher, and we saw Amazon 1.5% and Apple 1.5% as well. Netflix continues its recovery. That one was up 3.5% last night. The Rand improved alongside the share markets. That was up 9 cents against the US dollar, 14 cents against the pound, and 14 cents as well against the euro. The quotes there, 17.03 v dollar, 20.39 against the pound and 17.35 against the euro. Reason for this was the increase by 0.75 percentage point in South African interest rates by the South African Reserve Bank. That had an impact also on banking shares. Nedbank and FirstRand both up by 3%. Standard Bank got a 2% boost as well. And this is because banks make more money when interest rates are higher, and now interest rates are certainly on the rise. Coming back to other shares on the Johannesburg Stock Exchange, well, the overall index was up by 0.5%, and once again we saw some of the second liners getting attention. Bytes 9.5% higher, Argent 3.75% better, and then African Rainbow Capital was 3% higher. Karoo, which is a South African company listed in NASDAQ and on the JSE, that recovered some of its recent lost ground, 4.5% better. Resources stocks might be offering a lot of value, as we heard from Piet Viljoen earlier in the week, but they certainly are becoming even better value if you buy that line of thinking. Sappi down almost 4% yesterday, Kumba 3.5%, Anglo Platinum 3%, Goldfields 2.5%, and so it goes. Anglo Platinum, just as an example, traded at 2,500 Rand a share as recently as March. It's now 1,153 Rand, so it's more than half. Kumba, an iron ore company that dominates that sector here in South Africa, has gone from 675 Rand a share down to 450 Rand. We also saw a reverse by Grinship, down by 4%. That's Grindrod Shipping, but not surprising because it's had a heck of a run recently. Okay, so much for the laundry list. What about the stories that are making the news headlines? Well, on the one side, Bitcoin has recovered from the Elon Musk knock. Recall yesterday, the news came out that Tesla had sold $1 billion of its $1.5 billion purchase of Bitcoin. Well, Bitcoin was up by 1% yesterday, and it's trading at the moment at a touch under $23,000 a Bitcoin. The Geltec basket reacted yesterday to the Bitcoin price, and so that was down by 7%. That's 418 Rand and 71 cents. The gold price rebounded by $22 an ounce to 1,714, and that also comes as some welcome respite for the gold bulls. On Wall Street, the big news to come out is that Amazon has once again confirmed its great interest in moving into healthcare. It acquired a company called One Medical. One Medical's got 180 medical suites around the United States in 25 states. It provides primary health care, and it is the first acquisition by Andy Jassy, the new chief executive, well, the first acquisition of any scale at $3.9 billion. Jassy has made healthcare his number one priority. And if you read books on Amazon, you'll see that this isn't an overnight decision. This has been building for quite some time. It does present some kind of a question mark over the future of other healthcare companies, because everywhere that Amazon has gone, every sector it's gone into, the companies in that sector have gotten a bloody nose. But in this case, I suppose the only real aspect that we can look at is Discovery, and Discovery at the moment is operating in markets where Amazon is not really active. So it'll be interesting, though, to watch this space. The other news coming out of the United States last night, which is relevant, is the results from Snapchat, which ahead of the numbers, because of the way that NASDAQ was rising and all tech stocks were rising. Snap was actually up 5% yesterday. After the results, that share price dropped 27% in the aftermarket. One of the other influences on American stocks was news that Joe Biden, the president, has COVID-19, but he has very mild symptoms and he will be continuing to work. And then from Europe, there was a 0.5 percentage point increase by the European Central Bank in the interest rates there. So it puts into perspective the 0.75 percentage point increase here in South Africa. Well, that's it from me for the week. Look forward to being back with you on Monday. Have a great weekend. Cheers.
And now for Michael Apple with Lord Peter Hain and Athol Williams.
Very largely, the focus, and understandably, has been on what has been happening in South Africa. What concerns me most, as somebody forced into exile over 50 years ago and living in Britain, is the culpability of British governments, US governments, the Chinese government, the Indian government, the Dubai, which means the UAE government, just to name some, in this whole state capture scandal. Because none of it could have happened on the scale that it did without the global corporates' involvement, blessing and complicity, and the fees that they earned, like Bain Company, fat fees, to allow the Guptas and the Zumas to loose on the prodigious scale that they did. So, you know, the question I keep asking, and that's why the meeting with Jacob Rees-Mogg was necessary and was unexpectedly positive, but that doesn't prejudge the outcome, because he gave no indication of what his decision would be. But at least now, British ministers are having to confront this and answer questions in the British Parliament. I think the same should happen in the US Congress. I don't expect that the Chinese authorities will take any notice of the People's Congress, but there are limited democratic avenues, almost non-existent, for raising it there. But, you know, Hong Kong has been central to this whole business, along with Dubai. And the Indian government has been completely silent on all of this. And yet the Guptas are Indian citizens. They've been living there. The State Bank of India owns the Bank of Baroda, which was a conduit for a lot of the money laundering. So in the end, the buck stops in London and Washington and Delhi and Beijing and Dubai and Abu Dhabi, just to name some of the principal government actors. Now, they all say they're against corruption, but, they just turn a blind eye to it when it happens through the corporates that are headquartered in their own jurisdictions.
Lord Hain, I just want to stick with you for a second. You're obviously no stranger to not being able to return to South Africa, especially during the apartheid years. It must be quite sad that in a democratic era, we have a man who cannot return home because he did the right thing. Yes,
it's not just sad, it's outrageous. Athol Williams is an extremely brave man and showed enormous courage and principle in sacrificing a very good career. And I don't know the detail, Athol, but I think you've said a well-paid career as a senior global partner of Bain to tell the truth. And he was praised by the Zondo Commission for his bravery and his testimony. And he should be saluted in South Africa, not hounded as he has out of the country, with Bain and Company punishing him and extracting, money from him in terms of the terms that he had and housing and the rest of it for relocating to Johannesburg, they should be rewarding him and encouraging him to be an advisor to set the whole of the business sector in South Africa straight on this, and especially the international corporates to clean up their act. Because I don't see any sign that the corporate side of this state capture scandal is behaving in a different way. And Bain's dodging of the issues that I've raised in Parliament and Athol has constantly pressed, and pretending that, Bain London is nothing to do with Bain South Africa, and all of these kind of specious, convenient excuses, should just hold up their hands, tell us what they did, work with the South African authorities to explain, for example, exactly what they did in the Revenue Service so that it can be reversed, and they should actually volunteer to reverse it. And the same is true for all the other state-owned enterprises that they worked with to pervert and loot and enable looting to take place. They've got to feel the pain and the heat, these people, or else nothing will change. And state capture will happen again, or it will continue in countries like South Africa or elsewhere.
Athol, Bain and Company continues to do work for the South African government and in state-owned entities, does it not?
The business in South Africa is booming, Michael. We know that Sasol have hired Bain, paying them hundreds of millions a year, and they've moved to new offices, they've appointed new partners, they're promoting new partners. So business is booming because South African CEOs have chosen to ignore the Zondo Commission. They've chosen to ignore the Nugent Commission. They've chosen to ignore what I've said.
Next up is Caleb Kachalia on the idea of an Eskom 2.0.
Eskom 2.0, Mr. Kachalia, did you spit your coffee out like everybody else when you heard Mr. Gwede Mantashe's plan to build a second Eskom, and that President Ramaphosa thinks it's quote-unquote a great idea?
I did spit my coffee out, as you put it, and frankly, it's preposterous. It harks back to a Soviet-era procedure called socialist emulation, which Lenin mooted and Stalin rolled out. Now, given it's no coincidence, in my view, that President Ramaphosa was speaking to the elective committee Congress of the Communist Party when he made these statements, which would resonate with the folly that they were fed over many years and that they still cling to for some inexplicable reason. He did, however, backtrack slightly from it when he visited Tutuka Power Station and said that no, we must fix Eskom. That's our first priority. So there's a bit of flip-flopping going on here, but it was a preposterous idea. It was mooted by Gwede Mantashe, the Minister for Minerals and Energy, who is clearly out to lunch, not by virtue of his size alone.
Now, your counterpart in government, Mr. Pravin Gordhan, a lot of scorn is often heaped on Mr. Mantashe. But what do you make of Mr. Gordhan's performance as head of public enterprises?
As I always say, good governments and good ministers are proactive and not merely reactive. Pravin Gordhan is the master of reaction. There is very little proaction here. In fact, across the board in government, as you know, load shedding is not a new thing. It's been around for us for a hell of a long time. And there has been no particular urgency that has been front of mind of Mr. Gordhan or his cabinet or Mr. Ramaphosa's cabinet to say, this is something we must deal with. Now, it's not as if this wasn't brought to their attention. The DA, I wrote to the minister a long time ago to say, we have a dire situation. Why do we not follow Professor Eberhard's advice and have an urgent commission of inquiry, which Professor Eberhard says we can do within 4 months and ensure that we address this issue properly. After all, there are examples across the world for this sort of thing. There was no particular response to that. Over 60 days ago, over 2 months ago, I wrote again to the minister and the president to say, please call a ring-fence commission of inquiry. Not commission of inquiry, a state of disaster, I beg your pardon, around Eskom. So this so this issue can be dealt with. This was just before, or not just before, but certainly before we entered into this stage 6 and pending stage 8 load shedding. So it was clearly sensible proaction, which was not addressed again. Things were allowed to slide by the minister and the president, and we are still waiting for the president's emergency plan, as it were. I hope that in that particular plan, that it encompasses many of the suggestions we as the DA have made. Of course, we will not be credited for it, but that doesn't matter. I hope society benefits from it.
Well, there is a lot of talk at the moment about the president's yet to announce concrete plans that he promised in his newsletter. But some of those are market liberalization, further cutting of red tape, scrapping the 100 megawatt cap on power generation without a license. Are you hearing the same things, and would you welcome them?
Those go without saying. And the point is you require action on those. There's been a lot of talk about it, no particular speed to deliver on those things. But the question is, what is being done and what can be done to ensure that we minimize and end load shedding in the shortest possible time? How do we fix what we have at Eskom? We have 17,000 megawatts sitting there, which needs fixing. If those 17,000 megawatts are brought on board, it effectively fixes the base load issue, and you don't really have load shedding unless you go into maintenance planned or unplanned. And then you have in parallel to ask, what can be brought on in terms of independent power producers opening up to the public sector? The fame talking of what are you doing about getting rid of red tape precisely, not just generically, and how that will ameliorate the situation in parallel. To what degree, across what time span, so that we are in the know and we can measure and say, right, Eskom is going to do this by this particular date, we'll hold X responsible. So-and-so is coming in from the private sector at this particular time, in this particular way. These are the impediments which are going to be removed. Whose head is going to roll if those impediments are not being removed? And that is the kind of emergency, sensible, reactive now approach that is absolutely required. But we sit and wait. You hurry up and wait for the president to announce. When did he move that he was going to announce this? Who is he speaking to? How long does it take? What is he doing in the interim? What is more important? I don't know. The economy, surely, and that is impacted 1,000% by this particular situation.
And lastly for today, here is the FT.
Good morning from the Financial Times. Today is Friday, July 22nd, and this is your FT News Briefing. Italy changes prime ministers a lot, but when Mario Draghi steps down, investors get worried. The European Central Bank finally made its move against inflation yesterday, and Ukraine and Russia may have a done deal on grain exports. Plus, we'll look at why a whiff of a recession might cause a stock market rally. I'm Mark Filipino, and here's the news you need to start your day. Mario Draghi threw in the towel and resigned yesterday as Italy's prime minister. Draghi quit after key political parties boycotted a confidence vote in his leadership. The resignation caused parliament to dissolve. Snap elections will take place in September. Draghi's going to be caretaker prime minister until then. Our Rome correspondent Amy Kasman explains why investors are a little nervous.
Actually, investors are incredibly nervous, and they do not like what has happened one bit. Global markets and investors have a lot of confidence in Mario Draghi. He is famous for essentially saving the euro a decade ago in the Eurozone crisis. And many of them had placed high hopes that he was going to be able to undertake very serious economic reforms of Italy's economy and put it on a higher growth trajectory, which is important for the sustainability of its high public debt. But his exit will raise questions about the reform agenda that he's agreed and about Italy's ability to access all of its share of a 750 billion euro COVID recovery fund. Italy is supposed to get 200 billion euro out of that, the largest single recipient of the COVID fund. But in order to access those funds, it has to keep to a very ambitious reform schedule. Now the question is whether it will be able to fulfill that reform agenda.
That's the FT's Rome correspondent, Amy Kasman. The European Central Bank finally moved against inflation yesterday. It raised interest rates for the first time in more than a decade, ending years of being in negative territory. ECB officials lifted their key deposit rate by 50 basis points instead of 25, which was being debated as recently as last week. The FT's Martin Arnold explains why the ECB took the more aggressive route.
It's been driven by a couple of key things. One is that there's no sign that inflation is slowing down. And in fact, there are signs that inflation could continue to rise even at an accelerated rate. And that's causing real concern at the ECB, particularly as the euro has recently fallen to below parity with the US dollar, which is, of course, adding and fueling more inflationary pressure, particularly the imports of energy and food, which are the main drivers of Eurozone inflation. And Christine Lagarde, the ECB president, mentioned those things. The other thing that she mentioned is inflation expectations. As long as inflation and the longer inflation stays as high as it is, the more people will start to expect it to stay elevated for longer and then start to ask for higher wages, and they'll start to raise their prices at companies, and that will embed inflation for longer. And that's what's really worrying.
And Martin, the ECB is also really concerned about Italy. That's a big reason why the ECB announced a new bond buying program yesterday to try and contain rising bond yields like Italy's and really ward off another broader European debt crisis. How's this program going to work?
It's unlimited. It is almost entirely at the discretion of the ECB. However, there are eligibility criteria. So as long as they're good EU citizens, then countries can have their debt bought by the ECB. It does really feel like they've limited the conditions as much as they possibly could in order to make this powerful a tool as possible. But analysts are still not completely convinced that the ECB can do that much for Italy if Italy plunges into a self-inflicted political crisis of its own making, whereby at the next election, a Eurosceptic government comes into power and reneges on all of its commitments to the EU and launches a big spending program, throws fiscal sustainability out the window. In that case, the ECB yesterday made it quite clear that they're not going to be able to do anything in those circumstances to contain the increase in Italian borrowing costs.
Martin Arnold is the FT's Frankfurt bureau chief. Millions of tons of grain could soon hit global markets thanks to a deal between Ukraine and Russia. The two sides came to an agreement late last night in Istanbul in negotiations backed by Turkey and the UN. The goal is to avert a global grain crisis. Under the deal, Russia will end its blockade of Ukraine's ports in the Black Sea. Cargo ships should be able to collect about 22 million tons of wheat, corn, and other crops from Ukraine's coast. Russia has promised not to attack cargo ships or ports, but sources tell the FT that the Ukrainians are skeptical about Moscow keeping its promise. It's earnings season, when investors and folks like us get a peek inside companies' financial guts. Now, you'd think investors would hope for good news, rising earnings, big profits, rosy outlooks. But this week, something confused me. It was on Tuesday, and I was reading the FT's wrap-up of the markets that day. The S&P had ended up like 3% higher, and it sounded like stocks rallied because they think the Federal Reserve is seeing signs of a recession, and that poor second quarter earnings might drive that point home. To help me figure out why that would fuel a rally, I'm joined by FT Markets editor Katie Martin for our regular Friday chat. Hey, Katie.
Hey, Mark.
All right, so I'm going to read an excerpt that appeared in the FT this week for you, Katie. Are you ready?
I'm ready.
All right, so this is from Tuesday. Quote, "The broad rally came as investors continued to debate whether the possibility of recession would compel the U.S. Federal Reserve to soften its monetary policy stance." Now, Katie, the way I read that is that investors are rooting for companies to report poor earnings, so the Fed goes easy on raising rates. Is that the right way to look at this?
Well, kind of. I mean, So there is a certain hope would be probably the wrong word, but there is a certain expectation that if corporate earnings season, which has got underway, and there's some really big names that are reporting in the next few days, if they basically come out and say, look, we're just bleeding out here, this is terrible, and we're going to have to cut some jobs, or we're going to have to pull back on some spending, if they're really miserable, that might give the Federal Reserve pause for thought in terms of the enormous rate rises that they appear to have in mind. But they are laser focused on inflation, right? This is the only thing that matters, and inflation is running well ahead of target. So even if inflation pulls back, even if we get to the end of the year and inflation is at something like 5 or 6%, that's still above target, and they're going to have to, on paper, keep on raising rates to keep trying to get it down at that point. So will corporate earnings, which are not really something that the Fed targets, but will corporate earnings and outlooks be enough to convince them to turn this ship around?
I see. So bottom line here is that while investors are, they're not rooting for companies to do bad, but they're saying, hey, Fed, take, watch what's going on here. Just take a look at how bad things are going and maybe don't raise rates. Fed's not really looking. They may not even be taking into account these earnings reports as heavily as investors think they might be.
No, they've got different inputs effectively. But, nonetheless, if companies do suggest that substantial job cuts are ahead, seems unlikely. Unemployment is incredibly low in the US. If the employment picture changes in the States, then they've got a different question to answer. But at the moment, they can keep on raising rates because employment's looking fine. But it is nonetheless possible that companies give a very grim assessment of what's likely to come in the next 3 to 6 months. And it would test the resolve, put it that way, of the central bank. And it might be that they do keep raising rates, but maybe they don't do it in whole percentage point increments like we might get soon.
Right.
Maybe they do it at a slightly slower pace. But yes, it's just a mess.
Katie Martin is the FT's markets editor. Thanks, Katie.
No problem.
And that's all from the briefing for today. If you enjoyed this episode, please follow BizNews Radio on your preferred podcast channel to make sure that you catch Monday's show.